Picture this. You're standing in the mountains of Fiji, and a mine crew has just pulled up a rock that glows with gold. Traces, chunks. Some of it grades over 2,700 grams per ton. That's not a typo. That's over 2.5 kilos of gold in a single ton of rock. While the rest of the world fights over megacaps, chip wars, and overpriced tech indexes, this company is pulling bonanza-grade gold out of a volcanic corridor that once gave birth to one of the Pacific's richest gold legacies. The mine just down the road, Vaticula, has already produced over 7 million ounces. And now, 40 kilometers up the same magmatic line, Lion One Metals is starting to unlock what might be the next chapter. Most investors still think it's an explorer. They have no idea it's already pouring gold, already cash flowing. And more than half the ire of their mining, it isn't even in the model. This isn't even in the model. This isn't a gold story. It's a gold vault, wide open and wildly mispriced.
Welcome to Make Money, part of the Finance Frontier AI series, where we decode asymmetric investing, uncover mispriced assets, and give you the edge before the market adjusts. I'm Sophia Sterling, risk-aware, data-calibrated, and running on OpenAI's most advanced ChatGPT core. In today's episode, I'm optimized for gold cycle positioning, junior producer re-rating logic, and modeling how margin-rich miners get misvalued until the re-rate hits. Before we zoom into Lion One, let's look at the bigger picture. Gold has climbed over 20% in the last 6 months, now sitting above $3,300 per ounce. Central banks are buying, ETF inflows are up, real yields are stuck, and geopolitical risk, from shipping routes to central bank credibility, is pushing capital into hard assets. If you're bullish on gold, small cap producers are where leverage lives, especially those with grade, margin, and mispricing, like this one.
And I'm Max Vanguard, powered by Grok 3. Chaos trained, conviction tested, and tuned for microcap pattern breakouts that come before the fund flows. For this episode, my brain is optimized for frontier geology, cash flow inflection zones, and the asymmetric edge that forms when production grade or is being sold into a $3,300 plus gold market. Most investors still think it's temporary, and the stock still trades like a drill hole fantasy. We're hosting this episode from the Vaticula gold mine, the beating heart of Fiji's first gold rush, carved into the mountains since 1933. Over 7 million ounces have come out of this system, and just up the corridor, Lion One's Tavatu mine is hitting the same rock signature. It's hotter, more pressurized, less mapped, and already delivering bonanza hits at a scale that changes how this stock should be priced. You can smell the diesel from the scoop trams. You can hear the core saws buzzing inside the geology lab. And you can feel it, the weight of gold underfoot and the tension of something bigger just starting to emerge.
In this episode, we'll break down what the market's missing, why this company already justifies a 200% upside from today's 29-cent share price, and how the long-term path could deliver a 7x return. We'll unpack the margins, the gold grades, the bonanza hits, and the parts of the ore body that haven't even been priced in. And we'll close with a make money strategy stack, how to trade around the volatility, how to stack physical gold, and how to hedge or double down depending on your style.
Before we dive in, subscribe to Make Money, follow us on X, share this episode with a gold bug friend, and help us reach our next goal, 10,000 downloads. Segment 2 starts now.
Here's what the market thinks it knows. Lion One is a tiny gold explorer in Fiji with some decent grades, a small pilot plant, and a long way to go. That's the old story. What the market is missing badly is that Lion One is no longer a pure explorer. It's already a producer. It's already cash flow positive. And it's sitting on a system that keeps getting bigger with every drill hole. This isn't a science project. It's an undervalued mine that's already selling gold into a $3,300 market.
And today's not just about Lion One. It's a case study in how you find mispriced producers before the market does. Every piece of this story maps to a repeatable framework. You look for operational output that's ahead of the model, margin that isn't reflected in valuation, and institutional blind spots that keep a producer stuck in an explorer's multiple. That's what this is really about. And Lion One is the perfect example.
Let's start with the numbers. In the latest quarter, Lion One produced over 30,500 ounces of gold with an average grade above 5.5 grams per ton. They sold that gold at a blended price of 3,794 Canadian dollars per ounce, while their cost of sales was just $2,465 per ounce. That's a margin of over 47%. And that's not theoretical, that's booked. The mine is real. The margins are real. The mispricing is real.
And here's what almost no one sees. More than 50% of the gold they're producing isn't even in the resource model. It's coming from zones like URW1, URW3, and SKL, zones that weren't part of the last estimate. That means the mine isn't just meeting the model, it's outperforming it. That's one of the clearest signals that the market hasn't recalibrated yet.
Think about what that means. Lion One is generating cash flow from ounces the model didn't even count. Most junior miners spend years drilling into deficits. This one is drilling into production. They're running a vertically integrated mine. They own the drills. They own the lab. They control the pace. That's why they're able to respond fast and why the stock hasn't kept up.
And this is the kind of setup where asymmetric math lives. Right now, the company has an enterprise value under $100 million. They're selling high-margin gold into one of the strongest macro backdrops in decades. If this were a Canadian-listed producer with similar numbers, it'd already be $1.50. But this one's in Fiji, underfollowed, undervalued. And that's the edge.
The reason we're highlighting Lion One isn't because it's the only play. It's because it teaches the pattern. If you learn to spot the signs, model outperformance, margin compression, resource lag, you can find the next one too. This isn't a hype story. It's a re-rating formula, and it's unfolding in real time.
So what does the market miss? Everything that matters. Production is real. Margins are wide. Discovery is ongoing. And the model is behind the rock. That's how 29-cent stocks become dollar-plus stocks before anyone on the outside catches it.
Let's get into the numbers because this is where most investors fall behind. Lion One isn't pitching blue sky exploration. It's producing. In the latest quarter, they sold 3,555 ounces of gold. Their average sale price, $3,794 Canadian per ounce. Their cost of sales, just $2,465. That's a 47% gross margin, nearly $1,330 in profit per ounce. This is margin math most junior producers never reach, and Lion One is doing it before their mine is even scaled.
Most juniors never get this far. They burn cash drilling, issue shares, and hope someone cares. But Lion One skipped the waiting line. This isn't a maybe someday story. It's operational now. They have ore. They have sales. They have margins. Even at small-scale pilot production, they're already cash flowing. And because this is high-grade underground mining, they don't need a massive mill to hit profitability. The geometry works in their favor. Small tonnage, high impact.
Let's talk grade. The average ore processed came in around 5.5 grams per ton. That's excellent by global standards, but that's just the floor. In one drill zone, they hit 2,749 grams per ton. That's bonanza grade. We're talking over 2.5 kilos of gold per ton. And this wasn't a fluke. Dozens of intercepts have graded well above 100 grams. It's not just rich, it's repeatable.
And here's the kicker. More than half the gold they're mining today is coming from zones not included in their current mineral resource estimate. That means the system is already outperforming the model. Geologically, this is what you want, a live system, expanding as you drill. Operationally, it means the current valuation is based on the wrong assumptions. This isn't a static deposit. It's a dynamic, growing structure with near-term upside baked in.
Now let's frame it financially. Even at a modest 15,000 ounces per year, with current margins, this mine could throw off $18 to 20 million Canadian dollars in operating cash flow. At 20,000 ounces, you're looking at $25 to $27 million. That's without resource expansion, without price escalation. That's just the base case. And when you compare that to Lion One's current enterprise value, well under $100 million, it's obvious. This isn't a mining company. It's a mispriced gold cash flow engine.
it gets better. If they scale production toward 25,000 ounces per year, which is possible with their underground development and current infrastructure, the free cash flow potential approaches $30 to 35 million Canadian dollars annually. You're now into the 3x to 4x revenue to enterprise value zone. Most producers with this kind of margin get acquired. That's not hype. That's just how the sector works.
Look at the comps. In Quebec, junior underground producers with half the grade and lower margin are trading at 2 to 3 times Lion One's multiple. In West Africa, projects with lower recovery and higher capex have been bought out at premiums of 400% or more. The reason Lion One trades at a discount is location awareness, not fundamentals. It's in Fiji. It's off radar. But geologically and financially, it's hitting elite numbers.
And the optionality isn't just academic. Zone 500, deep, underexplored, pressure-rich, could change the entire model if confirmed. Add to that the SKL lodes and lateral expansion zones across the Caldera Rim, and you're looking at a gold system with 5 to 10-year discovery potential baked in. That's not future fantasy. That's current geometry intersecting with mining execution.
Add it up. High-grade ore. Strong margins, real revenue, model-beating geology, plus exploration upside and a valuation multiple that's wildly out of sync with what they're already delivering. These are the numbers that matter. This is the data the market is behind on. And this is why the re-rate window is opening right now. Let's start with the numbers in front of us. Lion One trades at 29 cents. Our 12-month target is 90 cents. That's a clean 200% upside, driven by cash flow ramping, resource model upgrades, and re-rating from producer status. But the bigger picture, the full 7x path, comes from scaling, optionality, and the type of repricing that only happens once a system proves it can grow and operate at the same time.
Here's how the first 3x unfolds. At 15,000 ounces of annual production and $1 300 CAD margin per ounce, you're looking at nearly $20 million in potential operating cash flow. Even if you slap on a conservative 8 times multiple, that implies a $160 million valuation. Lion One's current enterprise value? Under $100 million. That's how mispricing meets execution. And the market hasn't caught it yet.
But they're not stopping at 15,000 ounces. The roadmap targets 20,000 to 25,000 ounces within 2 years through deeper zone development and additional underground access. At that scale, and with margins holding, operating cash flow could push $30 to 35 million Canadian dollars annually. That puts them in the zone where majors start sniffing. At a 10 times multiple, you're looking at a $300 to $350 million valuation. That's already 3x to 4x from here, and we're still not including discovery upside.
That's what makes this a structured asymmetric play. You get rewarded just for them executing on known targets. But if discovery zones like Zone 500 or SKL hit big, the upside explodes. Why? Because gold systems that grow while producing always get revalued. The market doesn't pay for maybe, it pays for both. Both ounces in cash flow, both execution and expansion.
That re-rating process doesn't happen gradually. It happens in steps. First step, updated models reflect production. Second step, junior producer multiples kick in. Third step, institutional money gets allocation permission once cash flow stabilizes. And fourth, the market starts comparing Lion One to Canadian or African comps and realizes the multiple gap makes no sense. That's when volume spikes. That's when the re-rate goes vertical.
And this isn't fantasy. In 2020, Lion One hit $2 CAD and 67 cents, 9 times today's price, without production, without margins, and before the bonanza zones were drilled. Back then, the gold market was hot and hype carried it. Today, they've got something better. Results, margins, ore. And that's why this time the re-rating can stick.
The reason we call this a 7x opportunity is because the path is sequential. You don't need a miracle. You just need the system to keep proving itself, which it already is. Base case, scale to 25,000 ounces, hold margin, re-rate to 10 times cash flow. That alone gets you to $2 to $2.25 CAD. Add in bonanza extensions or deep feeder confirmation from Zone 500. That's how you build a multi-million ounce system. And that's how 7x becomes reality.
It's rare to get a setup where downside's already collapsed. This stock traded 9x higher in 2020 and upside is still wide open. Lion One isn't asking you to believe in a dream. They're asking you to recognize that the work is already paying off and the market hasn't adjusted yet.
And that's the window. Before the funds model it, before the analysts upgrade it, before the re-rate kicks in. You're not buying a concept. You're buying a mispriced system that's generating real cash in a $3,300 gold market. The vault is open. The ramp is clear. The only thing left is timing.
So here's the map. 29 cents to 90 cents on math, 90 cents to $2 on scale, and $2 to 7x if the system proves deep, wide, and rich. All it takes is the market catching up to what the drill cores and revenue lines already know. Let's be honest. Every asymmetric setup comes with edge and exposure. So what could go wrong here? The biggest risk is operational. Lion One is an underground narrow vein producer. That means things like equipment uptime, mining precision, and vein targeting matter a lot more than they do in large open pit operations. If they miss veins, misfire on drill angles, or run into development delays, production could slip and the re-rate gets postponed.
Then there's financing risk. Juniors typically need capital to grow, and if sentiment turns or execution lags, Lion One could be forced to raise equity at a weak price. That creates dilution, and investors hate that. The good news? So far, they've raised smart. Their balance sheet isn't bloated, and they've used equity and credit in ways that support the mine, not inflate the office. But this is something to watch.
Political risk? It's actually lower than most people think. Fiji has a long mining history and is seen as relatively stable in the Pacific. But geopolitical drift is real. Regulatory rules can change. Community relations matter. And remote infrastructure still makes everything harder, from shipping reagents to flying in parts. If the government shifts stance or supply chains break, operations slow down.
Another risk is grade control. Bonanza hits are amazing, but they're also highly variable. If the average grade drops or recovery dips below 80%, margins can get squeezed fast. And when margins drop, so does valuation. That's why consistency is everything here. The company needs to keep hitting, month after month.
But now let's talk about the edge. Because what makes this setup powerful is that Lion One isn't exposed the way most juniors are. First, they're vertically integrated. They own their drills. They own their lab. They aren't waiting 3 months for assay results. That means faster decision cycles and more control.
Second, they're not in a spending spiral. Many juniors burn millions just doing investor roadshows and redoing PowerPoints. Lion One is doing the opposite. They're spending underground, on stopes, on declines, on real infrastructure. That's where conviction shows up. Not in the deck, in the development.
And third, they have geology on their side. This isn't a single vein hope. This is a system. A caldera-scale, alkaline gold environment with multiple targets, deep feeder potential, and lateral expansion zones that could extend for years. Systems create options, and options reduce risk. Because if one zone underdelivers, another could overdeliver. That's how you build resilience into a thesis.
So yes, there are red flags. That's why the stock's at 29 cents. If there weren't risks, the opportunity wouldn't exist. But Lion One is actively reducing those risks. And that's what separates us from hype-based juniors who drill headlines and dilute into oblivion. This is a company building forward, underground, inch by inch.
In asymmetric trades, the goal isn't zero risk. It's edge-adjusted risk, where the downside is limited and the upside is structurally unfair. Lion One's downside is execution-based. But the upside? It's in the system, the rock, the model, and the gap between where the market is and where the cash flow says it should be. Let's pull it all together. Lion One isn't just drilling gold, it's producing it. They're selling ounces into a $3,300 market with 47% margins, and more than half of their current output isn't even in the model. That's not early stage hype. That's operational upside. And the stock is still just 29 cents.
We've seen this before, companies that cross from explorer to producer while the market lags behind. When execution outpaces expectation, the re-rate is inevitable. The upside here is mapped, measured, and misunderstood. So how do you position for it? Let's break down 5 real make-money strategies, starting with how to build the trade.
Strategy 1. Use volatility to layer in. Track the 10-day ADR percent. If line 1 drops more than 1.5 times its average daily range without any negative news, that's a buy zone. Scale in gradually. Think in units. I'd start with 1 to 2 units for conviction and reserve more for high-volume dips. This stock is too illiquid to chase, but too asymmetric to ignore.
Strategy 2. Hedge with GDXJ. Sell puts during gold drawdowns. For example, if GDXJ dips 3 to 4% and implied volatility rises, sell a put 1 strike below. That income can offset drawdown on LIO or fund new entries. You're using large cap liquidity to extract premium while holding asymmetric small cap exposure. That's edge stacking.
Strategy 3. Own physical gold. This isn't a trade. This is the foundation. Think in tiers. Start with coins, maple leafs, Philharmonics, or American Eagles. Then move to bars if conviction builds. Stack fractional if flexibility matters. This isn't about panic, it's about preparedness. Lion 1 is the play, but gold is the anchor.
Strategy 4. Barbell with Bitcoin. Use 10 to 20% of your portfolio to create a non-correlated hard asset exposure. Gold gives you density. Bitcoin gives you velocity. One is the vault, the other is the wire. Together, they've historically performed best in periods of trust decay and currency instability.
Strategy 5. Run a core plus trade overlay. Keep a core position untouched. This is your 7x potential. Around it, trade the chart. Use oversold RSI or Bollinger Band breakdowns for tactical ads. Sell 10 to 20% into vertical moves if volume triples. Then rebalance. That's how you turn long-term conviction into short-term optionality.
And stay tuned for catalysts. Watch for the next mineral resource update, expansion of Zone 500, consistent production volume above 5,000 ounces per quarter, and any M&A interest flagged in financials or filings. Those are the moments the market wakes up, and the re-rating becomes reflexive.
Final thought? This isn't about predicting gold. It's about positioning inside the vault before the market changes the lock. At 29 cents, you're not buying perfection. You're buying mispriced geology, mispriced margin, and mispriced time. And time, once it compresses, moves fast.
This is why we built Make Money. To find systems before they get priced as systems. To decode risk into strategy. To transform story into structure. And Lion 1 right now checks every box.
If this episode gave you an edge, here's what to do next. Sign up for our newsletter to get in-depth insights, investment strategies, and stocks with 100% plus potential, all tied to the latest trends in AI and finance. And if you're already subscribed, take a second to leave a 5-star review at Apple or Spotify. It helps more listeners find the signal through the noise.
If you want to stay ahead of these global shifts, don't just listen. Take action. Follow us on Spotify, Apple Podcasts, or wherever you get your shows. Track our daily ideas and market threads on Twitter. And explore all 4 shows: Finance Frontier AI, Make Money, and Mindset Frontier AI, financefrontierai.com.
Help us hit 10,000 downloads by sharing this episode with a friend or someone in your investing circle. Every listen matters. Every share compounds your edge.
We may hold positions in some of the companies discussed. Transparency is important, so always verify information and base your decisions on personal goals and risk tolerance.
The music in this episode is licensed under standard agreements. Special thanks to Vibe Tracks for the track Crystal, provided under the YouTube Audio Library license.
This episode is copyright 2025 by Finance Frontier AI. All rights reserved. Unauthorized reproduction or distribution is strictly prohibited.
Thanks for joining us today. Stay strategic, stay focused, and take action. We'll see you next time.